The foreign exchange market is one of the most fluctuating areas of study within financial markets. The foreign exchange or the forex market is the market in which currencies are traded. The rapid movements and natural volatility of the market makes it the biggest and most liquid financial platform on a global scale. Being the backbone of international trade and global investments, the forex market is critical in support of imports and exports necessary to maintain demand for resources, goods and services worldwide. The purpose of the market view therefore is to provide a means of foresight based on historical trends and economic indicators. In doing so, it allows traders within this market to prepare strategies of trading based on the market's movements, to create advantageous gains. The following will be a market view which has been prepared upon the two following pairs. To support our speculations, the main indicators which will be analyzed include relative rates in inflation, relative interest rates, economic growth trends and overall expectations in exchange rates. The following graph shows the current value of the Australian dollar against Japanese currency. Over the past few years, it is observable that the Australian dollar has weakened with respect to the Japanese currency. However, it has become formidable especially over the past year. Exchange rate movements are a factor in inflation. Global corporate earnings and the balance of payments account for each country, according to Cavarallo, in 2018. This indicates that an expected net growth in the next few months is a result of these preceding indicators. We will look to these now. The above graphs, gathered from the ABS and Statistics Bureau of Japan, show the relative disparity between the two commodities. Namely, the Australian commodity has a much higher inflation rate than its counterpart. However, Australia's inflation rate has been fluctuating at a much steadier rate. Japan seems to trending upwards in recent months consistently. So it is likely to continue that way for the next 3 to 6 months, and Australia's has been fairly constant around 1.9 lately, so it is safe to say it will remain so. Due to Australia's higher inflation rate than Japan, there will be less demand for exports and therefore less demand for the Australian dollar, as per the interaction of supply and demand. This carries certain implications which will be outlined in the conclusion. The above index shows the price of the same product across countries around the world. As we're interested in two specific currencies, we enter the Japanese and Australian sectors. By doing so, we can see that the same product costs 37% more in Australia than it does in Japan. Purchasing power parity theory suggests that the prices will align in both countries over time, therefore making the Japanese exchange rate stronger as they demand more of the goods. As can be seen in these graphs, the Australian interest rate reflects the Australian inflation rate with a dip in 2016 before trending towards recovery. The exponential increase in interest rates in Australia caused an appreciation in the Australian dollar as a result of inflation. Since the Japanese exchange rate has had an overall increasing trend of becoming stronger, and it can be subject to a self-fulfilling prophecy where people's expectations of the currency's strength alter their decisions to trade. In this case, since the Japanese dollar is strengthening, investors in FX such as banks, central banks, investment managers and hedge fund corporations will invest more in the Japanese dollar, further strengthening it. The small decrease forecast for the currency pair largely reflects Japan's very large current account surplus of around 4% of GDP. That large current account surplus, and associated large net international investment position, also makes the currency very sensitive to financial market volatility. Volatility has been low in recent years, but this could change as more central banks tighten monetary policy. Overall, the Australian dollar and Japanese yen pair are expected to stay relatively consistent for the next 3 to 6 months, with low risk and a slight decrease in the exchange rate due to increasing inflation rates in Japan's recent months. Moving on to the next one, This currency pair is one of the most major currencies in the world. This is supported with a survey which showed that this currency pair represented 17% of the total daily volume on the forex trading market. This survey was performed by the Bank for International Settlements. The economic indicators which affects the American dollar are GDP growth, inflation, interest rates and unemployment data, which is again reflected upon the pairing currency of Japan. It is assumed that the difference in interest rates set by the U.S. Federal Reserve and the Bank of Japan is the most significant factor affecting the currency pair. We will be looking at how inflation, unemployment and interest rates affect the currency pair. The recent monetary policy meeting held on the 8th of March this year by the Bank of Japan indicates that the relative inflation rate is likely to continue to rise, even though the economy is growing moderately and the current inflation is still below the 2% target. Recently, the Bank of Japan has decided to keep the rates unchanged as they are concerned that the momentum of inflation is not strong enough to get to the price stability target of 2%. On the contrary, the Federal Reserve has forecast an inflation growth median of 2.7% for 2018 with median inflation growth of 2% in 2019 and 2.1% in 2020. The Federal Reserve will make decisions for the next few years with the aim of continuing to get to the 2% stability point. Since the inflation rates of the United States is already at or above the target rate of Japan, United States will have less demand for exports which will lead to less demand for U.S. currency. The demand for imports will increase which in turn causes U.S. currency supply to increase. Inflation can either strengthen or weaken a currency. High inflation first makes a currency stronger because it leads to a central bank to raise interest rates which in turn makes a currency more appealing to traders. High inflation causes the currency to drop down because people spend less as they do not have enough. With the expected increase of U.S. inflation over the next few years above Japan's 2% inflation rate, the interest rates are increasing over the years as expected. Higher inflation rates leads to an increase of interest rates. Based on this figure, U.S. interest rates are currently much higher than Japan's. Japan has maintained consistency since 2009, whereas the U.S. rates are expected to rise still. Therefore, the forecast as per this information is that the U.S. dollar will appreciate over the Japanese currency over this forthcoming period. From this figure, on the 13th April the exchange rate can be seen. Looking at this graph, we expect the exchange rate to steadily increase over the next 3 to 6 months. This is supported by the fact that the U.S. currency appreciates due to the expected higher inflation rates over the coming year, causing increases in the interest rates. More Japanese currency current will be needed to buy the U.S. dollar since the U.S. dollar will become stronger. Speculators will be attracted to this currency pair, which will increase demand in turn causing the currency to appreciate.